Oh, it's that time of year again. Talk about cybersecurity. This is one of my favorites because we get to parse through about a million acronyms.
They're pretty egregious in their use of very confusing acronyms. We'll try to clear some of those, very few of them, up in this video today, right?
Yeah, we'll talk about Palo Alto Networks. We'll talk about some of their acronyms, the XCM or XIM, the XDR, the NGS. Let's break it down.
Maybe others. Oh, RPO. Don't forget RPO.
Oh, let's not forget RPO. Let's not leave that out. Okay, let's talk about Palo Alto Networks. This is one of our favorite cybersecurity companies that we own in our portfolio.
So by now, you probably know this is what some may call a legacy cybersecurity provider. Palo Alto started out doing network security, protecting physical locations, branch offices, storefronts, factories, and so on. Later on, private data centers, private networks. And now, more recently, in the last decade and a half, public data centers have really changed the game. And so companies like Palo Alto Networks figuring out how to add in layers of software based security on top of this quote unquote legacy network security products that they traditionally provide. And when CEO Nikesh Arora took over a number of years ago, it was a controversial strategy that he laid out. They made over a dozen acquisitions over the course of a few years, and it actually did work. It paid off. Their next gen security, or NGS, is the driving force behind this company now. They had been anticipating about 10 to 11% revenue growth to close out their fiscal year 2024, which ended in July. And they did beat those expectations, their own expectations. They ended up putting up 12% year over year revenue growth, just shy of 2.2 billion.
This 12% year over year revenue growth is actually pretty good. If you drop down one line to product revenue, you can see that actually decreased 5% year over year. So overall, the revenue increasing that much, 12% is very, very good. And then earnings per share on a non-GAAP basis came in over guidance at $1.51. And you can see it on an annual basis. Palo Alto hit their target just over $8 billion in annual revenue for fiscal year 2024 and earnings per share on a diluted basis at $7.30.
And we should mention that those earnings per share, that is on a GAAP basis. We'll circle back to this here in a moment because don't expect these GAAP earnings to stay quite so high in fiscal year 2025. But nonetheless, we show you this chart because under Aurora's guidance for the last 6 years or so, which is at the time where we actually made our initial purchase into Palo Alto Network stock, total transformation of the business, a lot of really, really good stuff happening. We have come to our first acronym of the day, RPO. Casey, tell the folks at home, what is RPO?
Remaining performance obligation, or RPO, is actually pretty important now because we're not focusing as much on billings in the metrics that we're looking at for the strength of Palo Alto Networks. You can see that RPO is growing and so is revenue.
Yeah, that's right. There's been some investor guff about this in the last year since Palo Alto Networks management team has said that they're going to be ditching that old billings metric. But honestly, Casey, this is something that we're fine with. It's something that we also talked about with Netflix. Netflix is going to be ditching some of its old metrics starting in 2025 as well. This is just natural as a company grows up, as it matures. Just good old fashioned things like revenue become a more important indicator. Revenue, profit margins. We don't need all the extra fluff and all the extra metrics to try to judge the trajectory of the business as much as when maybe it was a younger company. Maybe we need things like billings to try to figure out the trajectory of the business. And we can't rely on things like profitability. Maybe the company is only profitable by some metrics and unprofitable by others. So we can use things like billing to try to forecast when the company will eventually grow into being a profitable business. But these days, Palo Alto Networks, as we showed you earlier, is definitely profitable. And so billings are being dropped. Billings is a shorter term metric. Customer has been invoiced, but payment has not yet been received. So that's going away and replaced by this is RPO, remaining performance obligation. This includes invoiced amounts, but also future amounts under contract with the customer that have not yet been invoiced. We're not going to put a ton of emphasis on this particular metric. Ultimately, we're just going to rely on Palo Alto's revenue growth and their guidance from quarter to quarter and for the fiscal year, which we will get to. But we thought that we would address this one more time because I think we also got some guff from it earlier this year when we talked about this on the last Palo Alto Networks quarterly call.
One of the other things that a lot of investors or maybe analysts were concerned about was this shift to platformization, taking the focus away from what Palo Alto Networks was really good at, the hardware approach and services. Now they're focusing more on total platform hardware, software, cloud computing, edge network. They've got it all. And CEO Nikesh Arora addressed this. He said, I know that there was significant consternation around our platformization strategy 6 months ago. And one of the other things I'll just insert here is that they were offering the services to companies for free, essentially, so that when these contracts started to expire with other cybersecurity companies, Palo Alto Networks would already be in place. And so there was some discussion around maybe that was going to drive revenue down for Palo Alto Networks. But he says, I wish we had started down that path sooner. The amount of interest and activity around it has certainly been heartening and shows promise. After a strong addition of approximately 65 new platformizations in Q3, we added over 90 new in Q4. Now they have a total of well over 1,000 platformizations amongst the 5,000 customers as they exit this fiscal year 2024. So this strategy may have sounded a little scary at the beginning to some investors, but it has definitely worked out.
Yeah, for sure. I would say it definitely is. Now, when we get to the guidance for fiscal year 2025, you will see an effect of this platformization strategy at work on profit margins. We're getting to that. Just a little bit more on how this actually works. And there is a concern, I think, that maybe wasn't talked about as much. And this quote from Aurora is regarding the CrowdStrike debacle that caused the Microsoft Windows outage last month. Things like this have caused a lot of cybersecurity users to question what they have in place. And of course, Palo Alto Networks was able to start some conversations around that because of the CrowdStrike outage. Here's a couple more acronyms: XDR, Extended Detection and Response. And the other acronym here, XCM, Extended Security Intelligence and Automation Management. These are all part of the platformization strategy. A lot of these customers, maybe they have Palo Alto Networks network hardware installed somewhere, and they look at some of these software-based products that maybe they're starting to question having consolidated with a vendor like CrowdStrike. The concern here, though, is ultimately with these platformization conversations that everybody in cybersecurity is trying to have now. The industry is in much need of consolidation, which is well underway. Lots of acquisitions happening, lots of mergers happening, which we've talked about already in past videos. The question surrounding this is what happens if there's an outage? How much damage can it do if you have lots of services consolidated on one platform? It seems like earlier this year, a lot of the conversations we were having in talking about platformization, everybody was hot and bothered about the fact that, okay, but if I go with a platform, I'm not going to have the best of the best cybersecurity in every single category of protection. And as it turns out, that's probably not the biggest issue. The biggest issue is you probably don't need the best of the best in every single category. There's lots of products that are plenty good enough. But what happens if you have an outage? What kind of redundancy do you have built into your cybersecurity framework? As a large organization, especially, this is important. That's always the most primary concern, should be the most primary concern. Of course, you want to have adequate coverage, but you don't necessarily need to have the best of the best premium coverage on every single type of cybersecurity you have in place. Redundancy. This is a really, really important part of cybersecurity. And so that's something that I think we need to focus on as a lot of these companies, Palo Alto, Fortinet, CrowdStrike, Zscalers, and on this game too. Private equity is making acquisitions, and they're going to be talking about this as well. What is going to be the effect on customers, on actual businesses? Because many of them are definitely making the move and consolidating their services.
Yes, they absolutely are. This slide regarding some of the platformization deals that Palo Alto has made with customers, they have various levels, one platform, two platform, or three platform. They've signed eight-figure deals with a two platform customer. You can see a semiconductor company. And then on the three platform customer, an eight-figure deal with a global energy company. And then nine-figure deal with a global and media entertainment company on expanding their platform services. So it's working. One of the big components of platformization is the software and SASE, Secure Access Service Edge. And this is a small portion of the business for Palo Alto Networks, but how do we see this also playing into their expansion?
Yeah, this is a strength for Palo Alto Networks, even though that this is a small business. They are named a leader in SASE by companies like Gartner. And this is most definitely a platformization type of product because it combines network security with a lot of software security services and bundles everything together into a nice, convenient, usually multi-year package that covers all the needs of a large organization, everything from remote workers working from home or on the road to their office buildings where employees go and log in and access a private network. Now, this is probably a good time to talk about our video sponsor for today, Aura. It's a really important time to be talking about Aura because hackers have stolen the social security numbers of potentially every single American. Over 2.9 billion records were stolen from national public data, which offers personal information to employers, private investigators, staffing agencies, others doing background checks. Now, these stolen records include a person's full name, address, date of birth, social security number, phone number, all sorts of personal information. And members of the hacker group have reportedly released this information for free on the internet.
This news is super troubling. I know we've had our credit card information stolen, and that was a hassle to get taken care of. I can't even imagine what's going to happen when it's your social security number. But if you were taking precautions with your personal information online before this kind of thing should be a huge wake-up call. You've never been more vulnerable online than you are right now. I'm not too worried about it because I have started using Aura. Aura alerts me if they find my phone number, email, or social security number on the dark web. They're going to let me know fast if anyone tries to use this information to access my credit or bank accounts. They also give us up to $5 million in identity theft insurance should the worst case scenario happen. They also provide a bunch of other features to keep you safe online, all inside one single app. You can go to our link at aura.com/chipstockinvestor to try 14 days for free. That will be enough time for Aura to find out if any of your personal data is exposed. We recommend that you do this right now because not only is national public data not going to be doing anything about this to help you, it's possible they're not even going to face any repercussions for this leak. We're not leaving ourselves open to data breaches. And if you don't want to either, go to aura.com/chipstockinvestor to try your 2 weeks for free.
So this is kind of where the industry is headed. We talked about Fortinet in our last video, also building out its SASE network, which involves installing actual hardware into data centers in different points of presence around the world so that you have these secure locations from which to gather up user traffic located as close to the user as possible. So it costs money to build these things. This is ultimately, at the end of the day, a hardware based product. You have to put the stuff in the data center, then go get the customers and get them to sign a software as a service contract, essentially. But you can see it is working. Customer count of SASE up 21% year over year. And you can see nice growth from this segment. And signing these SASE deals is helping with the attach rate of some of the ancillary software services that Palo Alto Networks also offers. All of this feeds into that NGS, next gen security, that the company is really pushing for, being essentially the most important and most of the revenue by the end of this decade.
You can see that illustrated on this slide. The next gen security, they expect by fiscal year 2025 guidance between 5.42 and $5.47 billion and expected to be 90% of the recurring revenue in fiscal year 2030 at $15 billion.
They're anticipating significant growth over the next 5 to 6 years from this segment. One other point of caution here for Palo Alto Networks that will feed into the valuation part of the equation. NGS has been growing very quickly. This was largely built by multiple acquisitions, the dozen plus acquisitions Aurora helped orchestrate over the last few years. So it's been growing very quickly, and it's already expected to be about 60% of annualized recurring revenue this fiscal year that just started, 2025. So NGS has been on an impressive run, but it is starting to slow down a little bit starting this year. And so I think one question that we have that we'll be monitoring is how much of this slowdown in NGS revenue growth rate, annualized recurring revenue growth rate, is attributable to the platformization strategy, where they get some of these services installed into the customer's operations and aren't charging for it for maybe the first few months or for the first year or whatever until the old cybersecurity contract expires. And then they'll start pulling in revenue from that customer. It remains to be seen if maybe fiscal year 2025 is a bit of a slowdown in NGS because of that. And we'll be really anxious to see come next year, this summer of 2025, a year from now, if NGS maybe sustains low to mid 20% growth rate, or if they can maybe actually accelerate that growth rate a little bit further because of this platformization strategy. Something to keep in mind.
To look at the balance sheet for Palo Alto, total cash and short-term investments, $2.6 billion, long-term investments, $4.2 billion, and this current portion of long-term debt, $964 million. What is that, Nick?
Yeah, the debt has actually come down because a lot of that debt has moved out of long-term debt and into short-term current debt because they're convertible notes. So that debt is converting into stock. That's why the debt has come down. So Palo Alto Networks, very profitable, especially on a free cash flow basis, and they keep accruing more cash. But here in the last year, they've stopped repurchasing stock. They've had some of the debt convert into stock. And so we have had a dilutive event for existing shareholders here as of late. Now, they did raise the share repurchase program back up to $1 billion. So maybe they will start repurchasing stock again, and perhaps that will help remedy this issue. We'll be headed in the right direction again. But let's talk about the guidance. We promised we would point out another issue with profit margins because of this platformization strategy.
Next quarter, which will be quarter one of fiscal year 2025, they expect the revenue to grow between 12 and 13% year over year. And then on a diluted non-GAAP basis, net income, they expect year over year growth between 7 and 8%. For fiscal year 2025, the total year, they expect growth between 13 and 14%, and the income per share on a non-GAAP diluted basis between 9 and 11% growth year over year. So that income per share between 9 and 11% year over year, growing a bit slower than the revenue, which is not exactly what we like to see.
Yeah, of course. We, especially at this stage in a business's life cycle, we expect earnings per share to be growing much faster than revenue. So the opposite happening, again, this could just be the platformization strategy taking hold. So maybe a little bit of accelerating revenue as fiscal year 2025 progresses. But again, because this ultimately starts with installing network hardware, rolling out products, and perhaps not collecting revenue on those products right away, that might be what's hitting the bottom line in the short term. I would expect this to be a short-term problem and would expect to see a bounce back in earnings growth rate in fiscal year 26. Again, next summer, this time next summer. We're going to have to be patient and see how this pans out. But I think at this point, the good news is it is nice to see that revenue for the full year starting to heat back up again. It's starting to increase once more. And perhaps maybe we'll get some beat and raise guidance as the year progresses. Maybe we'll get up to 15% or maybe even a bit higher on revenue growth. So that's a good thing. We may just have to be a bit patient with the profit margin side, which brings us to another issue, Casey, because if you're looking at price to earnings ratio on a 1 year forward basis, this is a little weird looking, isn't it?
Price to earnings is currently at 49x. And on a forward price to earnings basis, you can see it's at 57. Valuation is definitely getting a little out of hand. And part of that is because the income tax benefit is going to be going away. Tell us a little bit more about how to understand that, Nick.
Yeah, that's right. You can see that highlighted there. They had a 1.6 billion income tax benefit in Q2. This would have been late 2023, early 2024 that they reported that. This is actually a very similar effect that we pointed out with Airbnb that happened in the last year. Airbnb is also having a similar issue with its price to earnings ratio on a GAAP basis because they also had an income tax benefit last year that will be falling off this year. So it makes this metric a little bit noisy. I would say the ultimate takeaway here, though, it is positive to see on the very last line, you can see GAAP net income very much still trending in the right direction, even if you back out that income tax benefit. You can see here in Q4, fiscal year 2024, 358 million GAAP net income versus 28 million last year. So big sizable increase. And so we would expect that this metric will actually continue to head higher up and to the right on a sequential basis this year. So that's good. But as you mentioned, it is throwing the valuation out of whack. So let's maybe take a look at free cash flow instead.
On a free cash flow basis, Palo Alto looks pretty reasonable, but still not cheap. On a price to free cash flow currently, that's right around 34x. And on a forward price to free cash flow, 34 to 35x. And the reason this free cash flow valuation is like this is because they've been spending money on building out their infrastructure, spending money on CapEx. Wall Street also feels like they're going to continue spending money on capital expenditures.
Yeah. Again, that SASE service, it's a network, it's infrastructure. So kind of flat guidance on a free cash flow basis. So I think ultimately at this point, we've owned this position for 6 years. We're more than happy to keep holding on to it. We have not added anything to it this year. And I'm not sure that should change just yet.
No, I would agree. If the stock is back to nearly all-time highs again, it seems like for us personally, this might not be a good time to add to the position, but certainly one that we'll keep holding and continue to watch.
I agree. It's not a value stock like we thought it was in 2022 and in 2023. On a free cash flow basis, it looked like a pretty good value at that time. Not saying it's egregiously overvalued at this point. And we are, you said, Casey, I'd agree. I'm a very happy shareholder. Aurora coming in 6 years ago has just completely changed the look and feel of Palo Alto Networks. And I think they're going to have plenty of good years ahead of them still. But at this point, I think we're personally in no hurry to add to our position. This is already our largest cybersecurity stock in our personal portfolio, but this is also the largest pure play cybersecurity provider. So it's definitely one that if you're trying to understand how this industry works and figure out how you would like to proceed to invest in it, at the very, very least, it would behoove you to try to learn more about this business and how they operate.
Okay, now you're up to speed on some of Palo Alto's wonderful acronyms. It's a lot of acronyms. Hopefully, you're also up to speed on what the stock is doing and how we view it here at Chipstock Investor. Make sure you hit the subscribe button. Check out Semiconductor Insider as well. $5 a month gets you access to a lot of exclusive content as well as live Q&As over on our Discord channel. And check out that sponsorship from Aura. Link is in the description below. Really cool product that I really found interesting to use. See you again soon at Chipstock Investor.